Hi, my name's Rohan, and I'm here to give you a brief introductory training session on consumer duty, providing an insight into the FCA's current regulations. Um, Before we go into the training objectives, I'll just talk a little bit about my background. So, I've been working in conduct risk, product governance, consumer duty, complaints handling, um, root cause analysis, and conduct risk, like managing conduct risks and looking at conduct risk metrics for about 6 to 7 years now. Um, and before that, I worked for the Financial Ombudsman Service investigating complaints between individuals and financial organisations. So I've got a wealth of information and experience dealing with customers, dealing with vulnerable customers, and understanding customer outcomes. The training session, learning objectives. So, after this session, you'll understand why we are in the current regulatory environment that we are in. You'll understand the FCA's overarching objectives. You'll get an introduction to the product governance rules for insurers. You'll have an introduction into understanding and handling vulnerable customers, an introduction into the consumer duty requirements, and an introduction into consumer duty MI and associated requirements. You'll also learn some practical steps that you can take to comply with the rules. So, in order to sort of understand why we are where we are today, I think we need to go back and look at what has happened in the past. The Financial Conduct Authority replaced an organisation called the Financial Services Authority, the FSA, and in 2006 the FSA introduced a rules called Treating Customers Fairly. Under those rules, businesses were required to put the customer at the heart of their business, and they were expected to deliver good outcomes for retail customers. And there was certain language around culture and governance, product suitability, clear communication, and no unreasonable barriers. This is all languages that is actually used in the regulations today, just in a different context. The Financial Services Authority had a few scandals happen on their watch, and we're going to talk about some of those scandals. Well, what I'll do is I'll talk through one of the scandals and I'll refer you to a few others if you'd like to research them in your own time. So the main one that affected the insurance market was the PPI mis-selling scandal, which PPI stands for Payment Protection Insurance. It occurred between 1990 and 2010, and it affected millions of customers who were sold PPI insurance designed to cover loan, credit card, or mortgage repayments if the customer became sick or unemployed. So some of the issues that occurred were essentially some firms added the insurance to customer loans without the customer's consent or knowledge. So the customer was actually paying additional premiums without knowing that they had this policy in place. It was sometimes sold to self-employed or unemployed customers who could never make a claim under the policy because you're required to be an employee at the time of purchasing the policy, a full-time employee at the time of purchasing the policy. Sometimes it was sold to the customers who were outside of the eligible age limit to make a valid claim. So an age limit could have been applied for 18 to 40-year-olds, and if you're above 40, then when you purchased the policy, you could never have actually made a claim under the policy. So what impact did this have, and how did it affect the FSA at the time? Excuse me. It meant that the FSA was always reactive to market events and therefore always late to the party. So essentially, millions of these policies were sold, and millions of complaints were raised through the Financial Ombudsman Service before the FSA found out about the issue. So the significance of the issue was not identified until years after the event, and it also became difficult to enforce against senior managers because there was little clarity around individual accountability for senior managers. So essentially, these sort of events decrease trust in financial services. Some of the other scandals that happened were the LIBOR scandal in 2012 and the financial market crash in 2008. If you'd like to research those in your own time. So what was the FCA's response to these issues? Essentially, the FCA felt that it was important to embed good conduct into firms from the top of the organisation. And set good incentives that would drive good conduct and good behaviour throughout the firms. And this is why you have the conduct rules and regulations. The product governance rules came into effect from the 1st of October 2018, setting of fair value rules, and these rules derived from the EU's Insurance Distribution Directive. The senior managers and certification regime came into effect in December 2018 for insurers and in 2016 for banks and investment firms to better link accountability in relation to what's happening and the products being distributed to the actual senior managers responsible for those products. Again, setting the tone from the top, ensuring good culture throughout financial businesses. Excuse me. Better control over financial markets there, so ensure. Excuse me. To ensure that the FCA can be there on time or prevent bad products being released to the market before they are actually released, rather than bad products being released to the market and then redress schemes having to be put in place to rectify the problems caused by these products. The way they intend to do this is by doing a data-led approach, comparing data from different market participants, i.e. the FCA fair value returns and the Financial Ombudsman Service complaint performance data publicly available to consumers and the market alike. So there's been a real shift essentially from products going out to market and then finding out there's a problem with the product and paying out a lot of redress and compensation, to ensuring that firms embed good culture and governance in their firms before they release products to the market, so that they can actually assess the risk of the product, understand where there might be customer detriment, identify the target market of the product, ensure that the product meets the objectives of that target market, and have those controls in place before that product is released to the market to mitigate the risk of issues and problems with that product. So product governance rules, the FCA Prod 4. The FCA product governance rules are designed to ensure that financial products are designed, distributed, and managed in a way that deliver good outcomes for customers. Firms must complete product reviews and retain evidence of the same. Reviews must take place before the product is released to the market. Product manufacturers must maintain and operate approval processes for each insurance product and significant adaptations of existing insurance products, in each case before it is marketed and distributed to the customer. Product approval process shall ensure that the design of the insurance product considered the objectives, interests, and characteristics of the customer, does not adversely affect the customer, and prevents and or mitigates customer detriment. The approval process also must support a proper management of conflicts of interests before it is distributed. So essentially the message is all of your risk analysis, your due diligence should occur before your product is distributed to market, and you have to have that process well documented, and governance processes in place to track any actions through to completion. So generally speaking, a lot of firms that I've worked at previously have set up committees such as a product oversight group, or sometimes these actions are conducted through the risk and compliance committee. You can have situations where you have co-manufacture arrangements. So you can have a co-manufacture arrangement between an insurer and a distributor, or you can have a co-manufacture arrangement between multiple insurers and still also have distributors in that chain. The co-manufacturers must have a written agreement covering their roles and responsibilities. All co-manufacturers are equally responsible for meeting the product governance rules, and you're unable to contract out of that responsibility. So insurers have been operating in this environment for the last couple of years, and it does cause some issues, which the FCA has said that they are looking to streamline and make more straightforward for insurance companies and distributors alike. It has led to duplication of process, co-manufacturers resulting in co-manufacturers reassessing the same information. So for example, different co-manufacturers can arrive at different product value related conclusions in relation to assessing the same information. So in some cases, data that they're being asked, in relation to also, it has been quite painful for some distributors, in the sense that distributors are being approached by multiple different co-manufacturers separately, asking them to provide information such as their remuneration or fair value statements. And in some cases, the information that co-manufacturers are asking for is different in nature, leading to the the distributors having to provide different or tailoring their approach to the information that they provide to different co-manufacturers in a distribution chain. So there have been some teething problems with regards to the implementation of these rules, and the FCA, with their, I can't remember exactly what their new objective is, but essentially to ensure that the UK is a market leading expert in providing financial services, and in enhancing that trust, consumer trust, and belief in UK financial services markets. Their goal is to make these processes easier for financial firms to do business, and to streamline the rules and make all the rules more clearer and more consistent across all of the markets and all of the different handbooks. And that piece of work is currently being undertaken, and we expect to see some more information from the FCA on that in September 2025. So the consumer duty rules. So these consumer duty rules enhance and build upon the standards that the FCA expects firms to deliver to retail customers. They build upon a new Principle 12, which requires firms to act to deliver good outcomes for retail customers. The rules have been in operation since the 1st of July 2023 and the 1st of July 2024 for closed book products. Now, this training session doesn't go into the difference between, open book and closed book products, but that can be something that I can discuss with you, or if you'd like a training session on that, please mention that in the comments below. So everybody should be familiar with the consumer duty rules. The 4 consumer duty outcomes: consumer understanding, the customer receives the right level of information at the right time, communications are clear, fair and not misleading, consumer support, customers receive timely service, and firms support their needs. Products and services, products must be designed and distributed to meet the target market's needs. Price and value, firms should ensure that products offer fair value and do not cause customer harm. And the 3 cross-cutting rules: avoid causing foreseeable harm to customers, act in good faith towards retail customers, and enable and support customers to pursue their financial objectives. So it then poses the question, who or what type of customers are in scope for the consumer duty rules? In the discussion paper 24.1, Regulation of Consumer and Bespoke Insurance, the FCA said, I believe this discussion paper was released in November or December 2024. Consumers and most smaller SMEs buying insurance tend to have limited financial expertise and generally do not have their own professional advisors. This can place them in a weaker position in transactions, as they usually have limited ability to, for example, effectively negotiate with insurance firms, and less capacity to resolve any associated disputes. As a result, there is a greater potential harm for these customers. So this is basically saying that there's an imbalance of power between financial firms and retail customers, and the FCA is touching upon SME type customers being considered as retail customers. there's a lot of contradictory information in the FCA handbooks about, who's considered a retail customer, and whether SME type customers should be considered retail customers. But what I would say is that, generally speaking, micro enterprise businesses, one man band in businesses, and SME type customers are generally considered by the FCA, can be considered as vulnerable customers, because if your conduct as a business can actually impact that business, that small business, and cause that business to go out of business, for example, if you do not have appropriate processes and governance procedures to manage those customer risks, or that wasn't considered at the very outset when you designed the product for those type of customers. So we'll briefly talk about the three cross-cutting rules. How can firms demonstrate that they avoid causing foreseeable harm? This is really looks like a really challenging thing for firms to achieve, but there are things that firms can do to mitigate against the risk of breaching this regulation. So in the first instance, ensuring that they have comprehensive due diligence on the customer, sales, distribution, service, and commission risks. Ensuring that they have the appropriate operational resilience processes in place, and that those operational resilience processes have been tested through to conclusion via the right channels. Completing and evidencing stress testing analysis. So, what would happen if you had a surge of claims, or an unprecedented number of insurance claims being made, and how would your business be able to handle or deal with that scenario? I think there is a shift now from the regulator that firms are expected to future forecast, in that they look at plausible scenarios that could likely happen or affect their business, and have in place mitigation strategies to prevent those risks, or minimize the risks to their business, and therefore minimize the risk to their customers. I think that there was a recent one with, was it Barclays Bank? A lot of Barclays Bank customers didn't have access to their online, I believe it was their online banking platforms, and I think Barclays Bank therefore allowed customers to be able to withdraw money from their bank account. I think that's what happened, but don't quote me on that. Act in good faith towards retail customers. So firms can demonstrate this by fully complying with the product governance rules, and continuously review product performance and listen to customer feedback. That could be through customer feedback forms, or through complaints data analysis. There you can get a lot of information from complaints data, looking at root causes of your complaints, primary and secondary complaint causes, and also potentially considering, for example, I'll give an example of primary and secondary. A primary cause of a complaint might be a decision to decline a claim, and a secondary cause may actually be the time that it took for the firm to reach the decision, or the service they received throughout the claims process. You can also look at data like the number of times it takes for the number of times the complaints team overturns the claims team's decision on claims related complaints. That could give you a picture as to whether the claims team is taking the right approach or a reasonable approach to the customer's circumstances. If there's a high overturn rate, then it could indicate that there's an issue or training requirements that are needed in your claims team. Ensuring that wordings, IPID documentation, sales processes include the appropriate information and remain clear, fair, and not misleading. And testing all of those communications, which is a key requirement of the FCA as part of these new regulations. So continuously testing those communications to ensure that the customers understands the information that they're digesting. And also providing comprehensive and frequent customer outcome training to frontline staff who interact with the end customer. So that'll be your underwriting teams and your claims teams, and actually your complaints team as well. So enable and support customers to pursue their financial objectives. What you can do is always remind, training throughout the entire organization that everybody must act to in the best interest of the customer at all times, understanding your processes around advised and non-advised sales, and ensure that the appropriate controls are in place around that, and completing assessments of the customer's demands and needs for a suitability of the product. If ultimately it's deemed that a product is not suitable for a customer, it's very important that in this day and age that the customer is informed of that fact, and maybe that they're signposted to alternative services that might be able to support them and in obtaining the insurance that they need, such as the BIBA, the British Insurers Brokers Association, which has access to brokers who might have access to different insurance markets that can provide the type of cover that the insured needs. So we'll briefly touch upon vulnerable customers. The FCA deems vulnerable customers to be a moving target. So that means that customers who you might onboard a customer who's not vulnerable at the point of purchasing the policy, but might become vulnerable at a different stage of your interaction with that customer. The FCA defines vulnerable customers as someone who, due to their personal circumstances, is especially susceptible to harm, particularly when a firm is not acting with the appropriate level of care. So there's 4 key drivers of vulnerability. These are just the 4 main ones. There are, other forms of vulnerability as well. So health, physical or mental health, life event, so something happening to a customer, such as a bereavement, job loss, going through a divorce, or suddenly having to take on caring responsibilities. Resilience, low financial resilience, such as having limited savings or being heavily in debt, and low financial capability or literacy, so having difficulty understanding financial products and services. We'll also talk about some wider research that I've done. Smart Money People completed a report on brokers and lenders. So this is mortgage brokers, and provided some key insights as to why brokers believe vulnerable circumstances are not disclosed to lenders. So as you can see, some people felt that they felt that vulnerabilities disclosures might have a negative effect on their mortgage application. Some clients didn't feel comfortable disclosing vulnerable circumstances. Some advisors felt that they were best placed to look after their needs. And some brokers said that lenders did not make it clear how to disclose vulnerable circumstances, and some lenders don't have a route for disclosing vulnerable circumstances. So some people also said that they felt that there may be some GDPR privacy restrictions. So I think this is really crucial and valuable data to understand some of the issues that affect markets, and this would also affect insurance markets as well, especially where you have an insurance company and a broker and maybe one or two brokers in the distribution chain. The broker who is dealing with the customer might identify a vulnerability, but then is that information being passed on to the insurer, and should that information being passed on to the insurer? So generally speaking, I think my personal view is that brokers should be, if you're an insurance company, you should make brokers aware of and understand your expectations of what information should be disclosed, when to disclose it, and how to do so. Brokers should, I think the message should be that brokers should obtain consent from their customers to share vulnerable information through the distribution chain, so that essentially then that customer only has to make that disclosure once and doesn't have to continuously repeat that disclosure every time. And I think also this can also apply to an individual firm as well. An individual firm might have a large company with multiple different departments, and a customer may be frustrated by having to make a vulnerable disclosure to several different departments because each of those departments don't talk to each other, or the file isn't updated, or the records updated appropriately. This can cause some real distress to customers. So it's quite important that the firms are on the ball with this sort of thing. So what can be done to support? So I think assure and reassure brokers that disclosures of vulnerability and additional needs can benefit the customer. So essentially, firms are required to offer additional support to vulnerable customers in a way that they deem suitable for their organisation, and have clear processes for reporting vulnerable customers, e.g. via bordereau columns, as a drop down yes or no to say whether the customer may be vulnerable, and maybe even a reason for vulnerability, so that you can capture that information, actually report on your population of vulnerable customers and your population of reasons for vulnerabilities. So you can sort of see how those customers are being treated in your on their customer journey, and whether they're receiving different outcomes to other types of customers. I also think that all the parties in the distribution chain should consider and be clear on what is on offer to support customers in vulnerable circumstances, so that everybody's singing from the same hymn sheet if there is a concern and some support needs to be provided. So I'll briefly touch on some consumer duty MI. Before, I used to call this conduct risk MI. You could call it customer outcome MI. I think the terms are very much interchangeable, but what firms should look to do is to essentially look at different metrics against different aspects of their sales processes. So in the first instance, you'd probably want to have some metrics around your product portfolio, and your number of high, medium, or low rated products. Maybe looking at specific products that are targeted at vulnerable customers and how those products are performing. Looking at underwriting data that's going to tell you how the product's performing from a customer perspective in relation to underwriting. So not just looking at profitability and sales metrics and and how profitable the product is, but also considering information such as cancellation rates. How many times, if you've got a high cancellation rate, that could be an indicator of poor product, or it could be an indicator that your sales processes, there's a flaw in your sales processes. Not taken up rates as well, that's quite a good indicator to look at. Not taken up rates would be the number of times customers interact with your sales team but don't actually go on to purchase the policy. If the not taken up rate is very high, so in that lots of customers are interacting with the service but not actually purchasing the policy, that could be an indicator that the product doesn't offer as much fair value, or hasn't got as much benefits as competition products in the market. Or it could indicate something else, some other issue with your sales process. And then also looking at claims data, I think claim settlement times, loss ratios, claims frequencies. These are all metrics that the FCA currently look at as part of their fair value assessment criteria. So that's always a good starting point. And complaints data. What are customers saying about your complaints when they complain? Are they complaining that they didn't understand something? Do they have expectations that they shouldn't have had expectations because your product doesn't cover what they're expecting to be covered, and understanding why that might be the case, and where that fault came up in the process. So all of that comes through root cause analysis, categorizing your complaints and looking at root cause analysis and putting that back, comparing that back against the other data that you collate in relation to the performance of the product. And also, again, vulnerable customers. Can you segregate your vulnerable customers and understand outcomes that they get and compare them against the outcomes that other customers receive? And is there any differences? And also potentially looking at whether your customers receive a different outcome based on different distribution models. So do customers who you sell to directly, for example, receive a better outcome than customers who purchase their policy via an insurance broker as part of a distribution chain? Right, so I think the key takeaway from this training session is that Consumer Duty introduces outcome-based regulations. Firms must evidence that they test and monitor customer outcomes against the rules. Testing and monitoring and evidencing that you're able to understand customer outcomes. That is sort of the bread and butter of Consumer Duty, and that'll be against the 4 Consumer Duty outcomes and the 3 cross-cutting rules. Firms are required to, as part of the product governance rules, continuously monitor product performance and show that they make changes to enhance customer value or improve consumer support and consumer understanding based on qualitative and quantitative feedback that you're analyzing in your data that you review on a periodic basis. And that you can understand different customer outcomes based on different distribution methods and different cohorts of customers. So again, um, when your product was launched, you would have considered your target market, and there might have been 3 or 4 different type of customers that you felt that this product would be distributed to, and as well as potentially having vulnerable customers in that portfolio, because anybody can be considered vulnerable at any point in their life. And then being able to separate out the outcomes and the data analysis for different cohorts of customers, ensuring that everybody receives a similar treatment, and nobody is sort of treated differently because they purchase their policy via a retail broker instead of purchasing their policy directly. So I appreciate that there's quite a lot of information, and that only really touches the surface. There's so much more detail and an analysis that can be completed to go through exactly what the requirements are and certain things that can be done to achieve the requirements. But if you would like to discuss this further in relation to how your business is meeting the regulations, please feel free to reach out to me. I'm happy to have a discussion with you, and we can talk about the services that I can provide in order to support your business. Thank you very much for joining this presentation. I hope that you found it useful, and I apologize for the few times that I yawned during the presentation. The information in this slide isn't too boring, I hope, but yeah, very crucial and critical information for your business nonetheless. Okay, thank you very much. Take care now. Bye bye.